Hello, everybody. How's it going? I didn't know if we would be back again this soon, though I kind of thought we would be, assuming something happened this week with MagnaChip, and it did. We got the middle outcome. The best outcome, of course, would have been the deal closing, but I think I put that 1% last week. I mean, I couldn't say 0% because you can't be 0% on something that you don't know the outcome of. And the worst case outcome would have been a 3-month extension to mid-March, where we're stuck in this purgatory. And then the middle outcome, which was what I was actually expecting or hoping for the most, is this, a deal break. We got the full United States breakup fee of a little over $70 million. And the company is free to pursue Plan B. Now, what is Plan B and how and when will it happen? Let's go through the press release they put out and we'll break it down. So first, the third paragraph of the press release, I'm just going to read it and then we're going to talk about it. While we are disappointed by the termination of our merger agreement, we are confident that MagnaChip remains well positioned to create value for our shareholders as an independent public company, said YG Kim, the MagnaChip CEO. This outcome does not impact the sound long-term fundamentals of our business and our ability to accelerate our MX 3.0 strategy. In fact, over the past 8 months, our team has continued to advance our previously announced 2020 to 2023 plans for sustainable and profitable growth. We will share further details about this plan progress on a call that will be scheduled for January 6th. I would like to thank our customers for their ongoing trust and MagnaChip's employees for their commitment to delivering industry-leading products. Okay, well, a lot to unpack there. First of all, I don't believe that the company would reiterate their 2023 goals, which I'll get to in a minute, if they were about to tell us that Q4 was bad and that 2022 is going to disappoint. Okay. I have very modest expectations for 2022 as it is, but given the supply constraints on the display business, any reacceleration of revenue growth there and the stock explodes. The power business is already doing great. The display business has been in decline the whole year due to supply issues, and the street's also obviously worried about Samsung. I do not believe any of that language would be in that press release if come January 6th, they're planning on resetting expectations for 2023. 2023 is just a year out. So what is the 2023 plan? It is for double-digit CAGR revenue growth, 9% plus free cash flow yield, and on revenue, and 30% plus gross margin. Well, the free cash flow and the gross margin have already basically been hit. They haven't really had great free cash flow this year due to working capital and CapEx needs, but the gross margin exploded last quarter as they changed the shift of the business as a result of those supply issues. Now, the key, of course, to the whole thing is the double-digit revenue growth. If they get double-digit revenue growth, again, you will see the stock explode because they hadn't have any revenue growth this year. And all these growth companies trade on top line acceleration, nothing really to do with the value investor side of bottom line and cash flow. So I'm really enthused by that paragraph. And a question that you might have is, why are they waiting until January 6th to talk to us? They've had months to prepare for this. It doesn't make any sense. And I was disappointed with that as well. My friend had an idea that maybe it was a result of them waiting to get Q4 in the bag. And then they can then give you preliminary Q4 numbers January 6th. They've done that in the past when they've pre-announced, going back to 2020 and 2019. You can go look. The company regularly would pre-announce revenue numbers when they've come in significantly apart from their guidance. So I think that that's the most likely reason for them waiting until January 6th. Sorry, I just got a text and I did not put this on disturb. One of these days, I'm going to learn how to do this so people stop texting me during the YouTube. The next paragraph, and I'm not done talking about January 6th and the next plan or whatever. The next paragraph says that they've implemented a poison pill. Now, I'm going to explain very briefly what a poison pill is. This really shouldn't be talked about much at all. A poison pill basically just makes it impossible for somebody or an entity to buy over a certain percentage of the company, period. So it doesn't make it impossible for the company to sell itself, but it just doesn't want an activist to come in and buy up the stock and then try to change the board or make a hostile offer for the company or whatever. And the threshold they use, the 12.5% for active or 20% for passive, is very generous. And I don't think this was done for any reason to think that the company is trying to stop a transaction from happening. I think that they know that they are vulnerable right now with a cheap stock price, and it's prudent to put that in place while they figure out their next steps. You don't have to understand anything. Somebody was asking me on YouTube, on chat, about what this all means, the $80, it's not. Pay no attention to any of it. It's never going to happen. It has never happened in the history of poison pills. When you put in a poison pill, the whole point is for it to not happen. So you don't have to worry about what any of this stuff says. Doesn't matter. It's totally irrelevant, and don't waste time on it. MagnaChip's board of directors is actively engaged in determining the best way to return and enhance value to shareholders. Accordingly, in order to allow adequate time to evaluate all options, the board has adopted a limited duration shareholders' rights plan. Okay, well, I want to go back to February of 2021, which was 9 months ago, 10 months ago, right before they signed the deal with Wise Road. So it was February 17th, and they signed the deal with Wise Road just 3 or 4 weeks later. This is from their conference call, okay? This is the CEO talking. Lastly, we plan to host an analyst day on April 20th, 2021. Our board is committed to maximizing shareholder value and is evaluating various options, including a holistic review of our capital allocation strategy, our target liquidity position, and our ongoing distribution framework. We recognize that the company may currently have excess liquidity. We plan to address, among other things, a comprehensive plan for near-term capital allocation, our liquidity, leverage policy, and our ongoing shareholder distribution on or before the upcoming Analyst Day. Okay, a lot to unpack there. I've talked about this before too, but let's really talk about this because it's very important. First of all, they're very good poker players because this was February 17th, and at this point, they were negotiating with 10 different people to sell the company. So, of course, it could have fallen through, but if you have 10 people in an auction, you're probably going to sell to somebody, the highest bidder, I would guess. So the fact that they are talking about this April 20th Analyst Day like it's ever going to happen is pretty funny. But there's certain lines in this paragraph that speak to what I believe is going to be an aggressive capital return policy. Namely, they talk about their target liquidity position, and they talk about how they're going to address, amongst other things, a comprehensive plan for their leverage policy. Their leverage policy. Now, either you have leverage or you don't have leverage. And currently, they have $8 a share in net cash. So if they were going to take on leverage, that would mean you would distribute that $8 and you would borrow some money to distribute some more money. Now, mind you, it's a $17.50 stock. I don't expect them to distribute $8 or $10 a share, but it's definitely something they could do. In fact, if I had to bet you, Wise Road was probably going to put somewhere between 4 and 5 turns of leverage on this company when they went private, which would have required them borrowing hundreds and hundreds of millions of dollars on top of distributing the cash on the balance sheet to pay for the $29 deal. They absolutely have room and liquidity and the kind of business that could take on debt. Hence why private equity firms are looking to buy them. Now, what do they do January 6th? Do they issue a dividend January 6th? Do they do a tender offer? Do they say that they need more time to assess alternatives? Because I'll remind you that they were originally supposed to tell us about their return of capital plan in the fall of 2020. It was supposed to happen in November of 2020. That was supposed to be the shareholder meeting. And they said because of COVID, they were going to delay it to the first quarter. And then they delayed it to April. We know they were lying. They did all that stuff because they were in a process. Okay? So whatever they tell us, I wouldn't necessarily believe it. But I think we win either way. Well, we only lose one way, but we win two ways. We lose one way. If come January 6th, they put out decent guidance and they do not announce a shareholder return plan, I think that means definitively they are looking at alternatives to the Wise Road deal. And they don't want to do something tax inefficient with the cash until they figure out whether or not there is an alternative they can do. Okay, that's how we win way number one. We win way number two if they do an aggressive capital return plan, which I would define as returning at least $3 a share in cash, and hopefully doing that via a tender offer, somewhere between $20 and $23 a share, which would retire 15% of the outstanding shares. And you'll get to a 2022 earnings power of, I would think, north of $1.75 on a $17.50 stock. And assuming they return to growth, the stock would be a double, in my opinion. Okay. The only way you lose, and I say lose, I just mean you don't win as much, is if they announce a return of capital and it's bad. They pay us $1 dividend or $1.50 dividend, and they say they're going to pay a 10-cent quarterly dividend going forward. And then maybe they put a stock buyback in place. If they don't do something aggressive with the return of capital, and if guidance is really good, the stock's going to go up anyway. But that to me would be the worst of the three outcomes. So to repeat, if they give us good guidance and no return of capital, bullish. They're looking at other opportunities to just sell the company. If they give us a return of capital and it's not that great with great guidance, bullish, stock goes up a lot. If they give us a return of capital, it's not that great and the guidance is meh, that's how you lose. That double outcome. What could the alternatives be here? I've talked about this before, but I can't stress this enough. If a South Korean company bought them, China and the United States can have no beef about this. It's a small little South Korean company. South Korea had a problem because they were worried about jobs leaving the country, and they were worried about China having their secrets. Obviously, if a South Korean company bought them, private equity or otherwise, that fear is alleviated. The United States, South Korea is the United States ally. The United States would let anybody in South Korea buy them because it's a South Korean company. It's not a United States company. And they can't stop someone in their own country acquiring them. Now, the only place where it would be hairy would be if an American company acquired them. You'd have potentially a problem with China because they're probably very angry that the Wise Road deal was blocked. And then you would have potentially a problem with South Korea because they would also be worried about jobs leaving the country. So the only way I see an American company being able to be involved would be in a minority way. So they structure it to where a South Korean company takes the controlling stake, and as limited LPs, some private equity firms in the United States come and get involved. I do not think it's a highly likelihood in the next 3 months that we get a transaction. If it was going to happen, it would be in the next 6 months. I do think that by June, at the absolute latest, you will have your massive return of capital. You will have a return to growth in the business because the supply stuff should really subside, and it should have a re-rating in the stock. And I think the setup for 2022 is just enormous. I never thought the stock could get this cheap. I thought $22 would be kind of the downside here on a break. And just to walk you through again how I get to that, if you just take what MagnaChip was trading at before the rumors of the deal, it was $19 a share. If you add $1.50 for the breakup fee, it might be a little bit less based on the taxes you have to pay. You get the $20.50. And then if you take the SMH and you roll it up 25%, you get the $25 a share. An alternative way to look at what it's worth would just be taking the $1.50, you get the $20.50, and then rolling your DCF out a year from where it was in March 2020 to March 2021. So add 10% to that, and you get the $22.50 a share. That's $22.50 versus $17.50 you are today, with no premium whatsoever for M&A. Now, a cynic can say there should be a discount for M&A now because no one can acquire them. But I just think that's complete hogwash. You don't need, I can't believe I just said hogwash. You don't need a company to have the ability to be sold to trade at a large premium. You know, large cap, mega cap tech stocks can never be acquired, and they trade at huge multiples. So that's not the reason why you buy a company. It's for the potential M&A one day. You buy it for return of capital, for growth, whatever. For DCF, you own the business. And the alternative way that and last thing, I talked this last time, but it's very important that you understand it. $29, what they paid for this in March of 2020 is not $29 today. Today, that $29 would be $29 plus $1.50 for the breakup fee, $30.50 plus a year forward in the DCF. So probably like $33.50. And if you want to do it based on SMH, then that $29 turns to $30.50. And then you add 25% to it, and you get to high 30s today versus the $29 Wiser had paid for it then. It's $17.50 now. With $8 a share in cash, they'll do over $1 in earnings this year, and they'll do over, I think they'll do $1.50 in earnings next year, even without a tender. Now, my buddy said that MagnaChip was downgraded today. I don't believe it was downgraded today. Oppenheimer just reinitiated coverage and reinitiated with a hold, which is actually great because now you have someone that can upgrade in January if they want to. I mean, it's a stupid upgrade game, but okay. It's not like if they reaffirm with a buy, it would be up more today than it is. So, and last but not least, I would like to make a small joke that my friend Sheep made to me yesterday. He thinks MagnaChip should be valued. This is a combo joke, but I came up with part of this, but most of it is his. He thinks MagnaChip should be valued in 3 buckets. You get the cash in the balance sheet. You get maybe 20 times the $1.50 earnings. And then he thinks you should get an annual multiple on a breakup fee for every time they do a deal. And he assumes they probably do a merger deal every year for the next 20 years. And every year it gets blocked and they get the breakup fee. So you should get probably a 15 to 20 times recurring multiple on that breakup fee. So that would get you another maybe $30 a share in value on breakup fees alone. I'm just kidding, in case anybody didn't realize that this was a joke. But he did say that, which is pretty funny. And that is the crux of my MagnaChip pitch. I think that the language in the press release is great. I'm very disappointed that they didn't have a conference call immediately and a return of capital immediately. But I assume that's because they're going to really do a comprehensive plan like they say they're going to do to figure out a way to make us a lot of money. The way I know that I'm not being intellectually dishonest about this is if they did a tender offer tomorrow at $20 a share, I would not tender my shares into this tender. Now, if the stock was trading at $15 or $16, I might have to do it. But if it was 19 or 18.50 or 19.50, it's very unlikely I would tender my shares. I don't think the company would take up the whole 15 or 20% that they tried to buy. And I think it would trade over as soon as they were done with it. I think that you would have to pay me right now $24 a share for me to reduce my position, $23, $24 a share. And I think that's low, but I'm so big in it. That's where I would be okay with tendering some stock. And I think it's just going to take time. Obviously, the reaction today is phenomenal. It's traded 1 million shares, and it's up 2.5% in this tape. And, ARBs have all the liquidity they want to sell. And you now have an event, a January 6th event, 3 weeks from now. Oh, my God, is it January 6th? Did MagnaChip schedule its investor call on the year of the insurrection? Year anniversary of the insurrection? They probably did that because they're going to announce such huge news that day. They don't want to make it on CNN or MSNBC because it's going to be nonstop wall-to-wall insurrection coverage. And they want to be under the radar to talk about how they're going to do $5 a share in earnings next year. That makes a lot of sense to me, actually. A Korean company scheduling a guidance call on the anniversary of the American insurrection. That's how they give CFIUS a real fuck you, by the way, because they're obviously not very happy with our American government. I wouldn't be surprised if MagnaChip's employees participate in the next insurrection. All right, let's see what the questions we have here. I think this is another likely year-end attack selling situation. I would just hold and or buy more. I think if that was going to happen, Glenn, you'd see it happening today. I mean, this action, you can't not love this action, right? In this tape, if it was going to sell off, it would have sold off today. Why would a tender offer be better than a special dividend? So there's two reasons why, Praven. One, it's more tax efficient, right? If I get a dividend, I'm forced to pay dividend taxes. If they do a tender and I decide not to tender into it, then there's no tax effect on anybody that remains with the company. Two, it creates massive accretion from a earnings per share basis. Now, of course, when a company pays a dividend, you could create your own buyback, your own tender. I could take that 15% dividend I get, $3 a share, and buy stock in the open market, and I get the same accretion I would have gotten if the company did it. There's no difference between those two things, but there is tax leakage. I have to pay a dividend tax, versus in this situation, it all stays retained with the company. Fat Eddie here, still waiting on that Twitter file acceptance. Come on, the members of the tribe, as well as Just Like Herb episode. Anyway, I digress. Fat Eddie, is that your name? Fat Eddie 423. Just send me an @ I'm sorry, buddy. Send me an @ and I'll see if I can let you in. It's really hard to navigate the Twitter. They fucked up the way that the pendings are now, and I can't find people on there. Just send me an @ I won't remember. Send me an @ When comparing to when they did the transaction, we didn't understand how limited the buyers could be here. And if anything, tech value maybe got re-rated lower since then, at least disputed. Now, Fat Eddie, I am going to have to disagree, because the semiconductor index, SMH, would be the best comp for a semiconductor company. Now, I don't think it's a great comp here because it's the way that the makeup is of that index, but it is up 25% from the day before the unaffected price of MagnaChip. It was announced in the Korean press that they were looking to sell themselves. So tech is not re-rated lower since then. Biotech is re-rated lower, but tech has surged. So no, things are only better in the tech world. Breakup fee math sounds like recurring Spark valuation. Exactly, Glenn. Now you're getting it. Speaking of this tape, what do you like that has good margin terms and is somewhat safe haven? Everything getting destroyed last month. I like Blackstone Mineral, Fat Eddie. I talked about it in my last YouTube. It's fully marginable, and I think it's got a tremendous margin of safety. And you have to have a K1 though, so it'll mess up your taxes. If you could deal with a K1, then I think you should look at Blackstone. There's some write-ups on Seeking Alpha. There's also a bunch of old write-ups on Value Investors Club that you can read that are not behind a paywall or a members wall. And that's my favorite kind of risk reward from a risk perspective. That's fully marginable. There's really nothing else that I like. I like VMware too, but VMware has really gotten destroyed. And my VMware position is in options. Right, but the other semis have the ability to be bought. I just kind of push back against that, Fat Eddie. NXPI was trying to be bought by Qualcomm. That deal was blocked. NXPI can no longer be bought by anybody, and NXPI has tripled, I think, in the last 18 months. NVIDIA can be acquired. I don't think it can be acquired. So this whole concept that a company will trade at an impaired multiple because they can't be acquired is just wrong. You need to have a right valuation, have good growth, and have a shareholder-friendly management team that returns capital. And the valuation will take care of itself. You're an owner of the business. I'm not renting it, hoping for M&A. I was in MagnaChip long before all this happened, but I've never been this big in it. I've never been close to this big in it. I was buying up until yesterday. I'm done. I don't have any margin left. I am I'm all done MagnaChip. Buy MagnaChip. Any other questions? I'm really happy to talk any more or flesh any more out if anybody has any other questions. I'm super excited about it. The CEO said more than a year ago that he would like to secure additional capacity. Isn't it likely that they disappoint with guidance since the display unit may not increase revenue? When you say disappoint, you're talking against expectations, Praven. So the street does not have MagnaChip growing much next year. In fact, I'll pull up the sell side estimates. And remember, they had a terrible year this year. So just to get, the street has MagnaChip growing top line 7% next year. The company in their 2023 plan is for double-digit CAGR on top line. That's a big difference between 7% and minus 3% this year. And remember, the power side is thriving, and they're going to have a 40% increase in capacity on the power side by the end of next year. I don't think it just switches on. I think it slowly comes on over the course of next year. On the display side, they're hoping to acquire more capacity in 2022. They didn't say at the end of 2022. So I think the first half might be more complicated, but they do better business in the second half anyway. So I don't think the company needs to put up amazing guidance. This stock is trading at like 6 or 7 times X cash earnings. It's not expensive. This is not trading like a high growth semiconductor company. You know, we need to have a little bit of context here. Groupon dead until New Year. Groupon might be dead for a while. I mean, they're not going to sell themselves, obviously. One day we might wake up to a quarter that they don't have declines. I don't know when that quarter is going to be. I still think the options are very asymmetric. You know, if it works, the stock goes to $40 to $60 a share. If it doesn't, I think it kind of meanders along. So yeah, there's better places I think to put your money than Groupon now, which is why most of mine is in call spreads. Very disappointed with how Groupon turned out. Very disappointed. Do you think worst case scenario is they just buy shares and maybe pay divvy for next few years if it's an acquisition penalty box? Yes, that's right. I think that they return capital pretty aggressively and they grow the company. In fact, I found this pretty interesting. When I was doing my research on CFIUS, I saw that in 2017, an American semiconductor company was blocked by CFIUS. Now it eludes me what the name of the company was, but it was a 1.5 billion or 1.3 billion takeout by a Chinese private equity firm. I can't think of what it was. And CFIUS blocked it. 5 years later, stock's up 10x, 1,000%. Never sold itself. You can bring them in. You can bring them in. I'll show them to the people. You guys want to see the twins? Hi, come here. Come on. Wow, you guys are in for a treat. Look at you walking.
Chant, really.
Come here.
You okay?
Hey, Leo.
Are you
That's Sam.
Yeah.
Say hi, Sam.
Hi, Dad.
Hi, Dada. Hey, Leo, come over here. Leo, come here. Leo, come here. Oh, come here. Perfect. Come over here. Come here. Come here. This is a public service announcement for birth control. Always use birth control. Don't worry, guys. I love you, but just saying. Come here. Come here. Maisie. Yeah, it's Maisie. Come here. Come here. Let's see what I was just finishing. So, yeah, so I think that they would do an aggressive capital return strategy. And that's what I was telling you about the other company that was up 1,000%. And again, yes. Hi, will you come over here? All right. I don't think I'm really going to get anything done right now. What? Yeah, cool. So there's a plan. There's a game plan. NXPI is another great example. NXPI blew up when Qualcomm didn't buy them and has been nothing but a rocket ship since. Now, I'm not saying that this is the same business and it's not a great, perfect comp or anything like that.
Okay.
But it shows you that there's life after a dead acquisition. All right, I'm going to take them away. Yeah. Oh, stop. That's a great idea.
All right, let's go. You guys want to go say hi Ola to Veronica? Ola, let's go.
Bye, thank you. That was fun. All right. Anything else? I just have a really hard time seeing. Let's try to come up with what the bad outcome could be. So let's say that they guide to next year flat with this year. So they'll do $1.10 to $1.20. And that's not all what they talked about with this 2023 plan, double-digit CAGR of revenue growth. Let's say the stock goes to 15 from 1750 here. So you have 250 downside, okay? So 15% downside. Do you know how much stock they could buy back at $15? Half the company, half of it, okay? They won't, but let's say they buy back 25% of it, okay? They buy back 25% of the company at $15. That $1.15 or $1.20 of earnings turns into $1.40 to $1.50 in earnings on a $15 stock price. That'll still have $4 or $5 a share in cash. It's crazy. The stock is so cheap. Okay, you need Samsung to pull all their business. You need a black swan situation for this stock not to work. I don't even think a bad stock market would really hurt it because it's so inexpensive. But obviously, I'm terrified of what the stock market is doing these days. So I wouldn't wish for that. Bad outcome is their limited product line turns out to be in high decline. Sure. I don't think they have that limited of a product line though. I think it's a lot of different end pieces that they sell into, Glenn. And the end markets of those things are booming. It's all 5G crap. All right. I'll log off. I think that's all I want to say. Fat Eddie, I'll look for you right now on Twitter. Good luck, everybody. Stay safe out there. This market's nuts. I still own all my CTIC. That's been amazing. Very happy with the way that's acted. And I should have said, by the way, CTIC could have news before the PDUFA. Glenn asked, when the PDUFA date is. If really all they're doing is trying to look at one minor piece of data, it's definitely possible they grant them accelerated approval well in advance of that February PDUFA date. All right. Take care, everybody.